we come to the next aspect, finance out there. I am just going to drop out here, I am going to use a different color. What is finance? In this particular case, when I talk about finance, I am going to more be specific on corporate finance. Typical corporate finance has to do with two basic aspects. What are the two aspects? One, to source money at lowest cost. Second, invest that money at a return which is high. Given your risk appetite. I use risk ability. Typical corporate finance is to do with only two functions. Source money at the lowest possible cost. Invest that money in an option that gives you highest possible return given your risk taking ability. Given your risk taking ability. Now I can say, somebody can, why that risk taking ability comes in there? Because when you sort of make investments of that money, money is going to give you return, the investment is going to give you return, and you could say, I am just going to go and gamble today, or I am going to just go and bet all the money that I borrowed on a horse today, in a horse race today. You can do that. That means what's happening? Your risk appetite or your ability to take risk is extremely high in that case. So the probability of failure is also going to be extremely high in that case. So when you do that, the source from which you borrow, the cost from which you borrow, the cost of the source from which you borrow will also be high. Let me give you a simple example. I will say I borrow money, sorry, I'll say I borrow money to invest in a very safe asset. Now the person who is lending me the money will certainly know, if I invest in the safe asset, I will get money return back. If I get the return back, I will return his money. So he is very confident that he will get back the money what he has given to me, unless I have a very wicked intention of not repaying. Let us keep the wicked intention aside, let us keep honest business. So given that, what does that fellow say? He will give me money at a very low interest cost. He says, I am very happy with a small interest out there because I am sure of getting the money back. I go to him and say, I will take the money, borrow the money from you, but I am going to take the money directly to the race course today and bet on a particular horse. He knows that if I lose, I may not return his money because I don't have the money. I may not return his money I have borrowed. So what is happening? The risk that I am taking is very, very high. Because of that, the lender who is giving me the money is also taking equal amount of risk. So he is going to charge me more and more in that process out there for the money that he is going to lend it to me, because he has to cover the risk out there. So in short, when we talk about corporate finance, it is just that sourcing money at the lowest cost, that is the first objective. Then investing money in an option that is going to give me the best possible return. Instead of the highest return, you can even say, you can even rephrase it to what is called as the best possible return out there. Best possible return given your risk appetite or risk ability, given your risk ability out there. So, when we say finance, corporate finance, the job of any corporate finance, if we we have CFO out there, he is a CFO in X organization, Y organization, etc., etc., etc. out there. What is the job of a CFO? The job of a CFO, if I have to put it in very, very crude, simple terms, is to source money at the lowest cost, invest in the best possible, what do you call it as, best, invest in an option which is going to give me the best possible return. Wow, it is so easy. Then why are the CFOs paid high? Then why is their job very tough? You might ask me. But sourcing money at the lowest cost is the toughest job, and even tougher is investing money in an option which is basically going to be giving you the best possible return, and timely return, that is even more important. Timely return in the sense, imagine I have borrowed money, I have to repay it next year, I have to invest also in a way that my return, or I will get back the investment next year so that I can repay that fellow. If I have invested in an option where I am going to get the return only after 3 years, next year when I have to repay that fellow from whom I have borrowed, I will not have money. So, what I will do? I will go back and borrow again, and I am getting into a vicious circle in the process. That is what we call it as ALM, asset liability mismanagement. Let us all get to all that as we go. So, that is sourcing, investing. These are the two core aspects when we talk about corporate finance. Now, when we say sourcing money, there are various options of sourcing money. Sir, how do you source money? You borrow. No, borrowing is one source. You can raise equity in the market, issue shares and raise equity in the market. We will go to that as we go on. We will come to, we will discuss about equities per se specifically as we go on. Even borrowing, there are a multi-million ways I can borrow. I can borrow from the public by issuing debenture, I can borrow by issuing a bond, I can borrow from a bank, I can borrow from a financial institution, I can borrow from what do you call it as by from an institution which is abroad. Say for example, you said today you would have read a lot of reports about SoftBank of Japan lending money, etc., and so on. I can raise money through a venture funding, I can raise money through various forms out there. Then my investment options, there are umpty number of options. I will be very clear of the investment option that I have chosen before I raise money, so that my interest rate on the borrowing will get dictated based on that. So, that is basically deciding on the source, multiple sources, it will not be a single source, a combination of sources, and then finding avenues to invest. These are the two core aspects out there of corporate finance. We will deal with this also. While dealing with this, you have to remember there is one more aspect when we talk about this, and that is what we call it as, let me use a different color. We call it as time value of money. What is the time value of money? Please note, a rupee today is not the same, a rupee today is worth much more than the rupee tomorrow. That is, supposing you have 100 rupees, you buy a particular product for 100 rupees today. 1 year down the line, to buy the same product, you will not be able to buy it at 100 rupees, you will have to pay little more than 100 rupees. So, what is happening? With time, the value of money is reducing out there. Why? It could be inflation, so on and so forth out there. I am not getting into the economics or the reasons behind all of it, and that is what we call it as time value of money. So, when I say sourcing money, imagine I have sourced about $100,000 as of today, or let us say 1 lakh rupees as of today. I have made investments, and the investment is going to give me return after 5 years, and after 5 years it is giving me 1,10,000. Is it worth investing? Well, at the outset you will say yes, it is worth investing because you are getting 10,000 rupees more. But what is the value of that 1,10,000 5 years down the line? As of today you are putting in 1 lakh, you are going to get 1,20,000, 1,10,000 5 years later. What is whether the 1 lakh today is more than 1,20,000 5 years later, or is it lower than what I am going to get 5 years later? Let me repeat it. I know it's a little confusing for you. Imagine I spent 1 lakh today. 5 years later, I am getting 1,10,000. The value of money is depreciating at the rate of about 5% every year. That means over 5 years what happens? The value of money would have depreciated about roughly about 25% out there. So, 1,10,000 if it is depreciated, that is if it is 1,10,000 5 years down the line, is worth what as of today? It is basically worth far less than 1 lakh as of today, because money is depreciating at the rate of 5%. I mean hypothetically it is depreciating at the rate of 5% every year. So, 5 years down the line, in 5 years it will depreciated about 25%, am I right? So, that 1,10,000, what is the value of that 1,10,000 5 years later? What I am going to get? Value of that money as of today. Why as of today? As of today I am investing that 1 lakh. What is the value of that 1,10,000 as of today? So, I will have to reduce it, that is money value is reducing at 5% every year for 5 years. So, that money value, then naturally the 1,10,000 what I have got 5 years down the line, what is the value of it today? It will certainly be less than 1 lakh if it reduces, if money value decreases by 5% every year. If money value decreases, I am not getting into the calculations of it, money value depreciates by 5% every year. So, when you make these investment decisions, that is I said, you also will have to keep in mind what is called as the time value of money. Sir, how will we know at what rate the money is going to depreciate every year? Well, there are scientific methods of knowing that. Let us not even get into the methods of what is called as assessment of this discounting or time value of money. There are many methods for assessing that. So, when you make this sourcing as well as the investing decision, you will have to keep in mind what is called as this time value of money also. And when we say corporate finance deals only with sourcing and investing. Sourcing lowest, investing with the best possible return with time value of money. That is all what we do in finance, corporate finance out there. Of course, having said that, there are number of other areas of finance, verticals. Somebody can say, I will do what is called as, one of your friends would be saying, we will do what is called as investment management. What is investment management? You invest in securities, you invest in stocks, you invest in real estate, you invest various places, and then objective is what? The same, invest, get best possible return. So, it basically boils down to the same thing out there, invest and get best possible return out there. Invest means source money at the lowest cost and get best possible return out there. That is what we do. We also talk about, then what do you call it as, somebody would say, oh, we will do investment banking. We will also do what is called as valuation. We will also do what is called as derivatives, DE, derivatives. So, when we say what is derivative, again instrument for investment, instrument for, sorry, not investment, hedging your risk. Again valuation, you are valuing your investments, the future value, assessing the future value of your investments. All these things basically, again all of it boils down to these two simple things out there: sourcing money at what do you call it as the lowest cost, investing money at what is called as the best possible option, which gives you the best possible return. So, in short, in summary, I am going back here, accounting and finance. Accounting and finance, when I talk about two different forms. First form, financial accounting, record a financial transaction, then based on that assess the financial position. Do we learn this? Yes, we will learn that. Almost about 50% of the course, this particular course will be focused only on this particular aspect, financial accounting, that is record a financial statements and assess the financial position of the company. Another 20% of the time I am going to spend on this cost accounting part of it. When I say cost accounting part of it, I am predominantly talking about the kinds of decisions. I am not going to go over all the kinds of decisions what management, what a company would make using this information. I am going to touch upon very few key specific decisions out there that management may make using this particular information. When I say few key decisions, it could be basically your allocation of overheads or pricing decision and so on and so forth. Few key decisions using the accounting information what the company will make. Then the next 30% of my time will be spent on finance out there. That is, in finance, I am going to talk about how do you assess the sourcing of funds out there, and then how do you look at the time value of money, and how do you choose your investment options, how do you discount it and make decisions out there, and that is all what we are going to do out here. So, it will give you, as I had said earlier, a broad overview of assessing the financial, recording and assessing financial position, assessing the information for accounting information for decision making by the company, and analyzing what do you call it as the sources of funds and your investment options that you have, and that is what this particular course is going to give you. Almost close to about 40 to 50% of my time is going to be on financial accounting. That will give you the assessment of financial position, and that assessment of financial position is required when you basically use even your what do you call it as choose your investment option out here even for this. Why? Because your investment option has to give you return, best possible return. How will you know it is giving the best possible return? Only by analyzing the financial position of the investment. How do you analyze the financial position of the investment? Using financial accounting information. Very simple. I go and invest my money in company X. I want to know whether the company X is going to give me return. How will I know whether company X is going to give me return? I will analyze the financial position of the company. How do I analyze the financial position of the company? I will take the financial accounting information, analyze the financial position of the company. That will give me an idea whether I am going to get the best possible return. So, again it is interconnected in that sense. So, that is why I will spend about 50% of my time, 40 to 50% of my time in analyzing the financial position, and about 30% of my time in sourcing and investing options out there, and time value of money and so on. So, this gives you a complete overview of what I would be covering as far as this particular course is concerned. In the next class, we will get into the what do you call it as the details of financial accounting. I am going to start with financial accounting. I am going to have some numbers. I am going to have some numbers which I am going to sort of use for recording and analyzing the financial statements and as assessing the financial statement out there. And those numbers what I will be using will be put up along with what do you call it as the recording for the next session that I am going to. After that, we will slowly move to cost accounting and finance. Thank you.